Welcome back to the deep dive. So, if you thought the market was going to just, coast quietly into the new year.
Yeah, moving sideways in that holiday chop we saw.
Exactly. You were completely wrong. The final reporting window of the year is closed, and the data shows something much more significant.
It shows aggressive, clear positioning. This market is not drifting.
Not at all. It feels like it's solidifying its foundation.
That's really the essential takeaway. I mean, in the last 24, maybe 48 hours, we've seen 3 huge macro stories break almost at the same time.
And this isn't just about price wiggles. This is about the fundamental utility of the whole asset class changing.
It is. So our mission today is to give you the shortcut, to really unpack these themes that are going to define, I think, the first few months of 2026.
All right, and we have 3 pillars for this deep dive. First, what looks like the official start of a global yield war, and it's being driven by China's big pivot on the digital yuan.
Then second, we're seeing this massive industrialization of institutional capital. We're calling it institutional entrenchment.
Through staking, M&A, all of it.
All of it. And third, we'll look at the market structure itself, the security landscape, a coming supply shock, and some, frankly, serious centralization risks that institutions now have to price in.
The overall thesis here feels pretty clear, and it really affects every single asset out there.
It does. We are moving away from the era of pure speculation and, well, firmly into the era of structural utility and integration.
Okay, let's unpack that first one because it feels like a massive geopolitical move. The People's Bank of China, the PBOC, has made a strategic shift on the digital yuan, the ECNY, that is, arguably the biggest monetary policy decision we've seen this window.
I'd agree. They've essentially redefined what a central bank digital currency can even be. So effective January 1st, commercial banks are going to start paying interest on ECNY wallet balances.
And that's a huge pivot. Historically, a CBDC was designed to be M0 money.
Exactly. The digital equivalent of the sterile paper cash in your wallet, no interest.
This changes the entire classification.
Absolutely. The ECNY instantly goes from that M0 cash substitute to an interest-bearing M1 or M2 digital deposit. And to make sure people trust it, these balances get deposit insurance and a 100% reserve requirement.
So this isn't just some tech upgrade.
No, this is full integration into the sovereign banking system, just, running on digital rails.
Okay, so if M0 is the physical dollar bill in my wallet, China is basically turning that bill into an instant digital state-backed savings bond.
That's a great way to put it.
And here's where it gets really interesting. This is a direct shot, right? A yield war aimed squarely at private stablecoins like USDT and USDC.
Precisely. Private stablecoins, they generally pay 0 interest to you, the retail user. All that yield from the reserves, that stays with the issuer.
But China is now offering a risk-free, state-backed, immediate yield. That's a massive incentive to keep capital inside their sovereign firewall.
It is, but let me push back on that for a second. Isn't the whole point of private stablecoins their lack of sovereign interference? The fact they operate outside one state's control.
That's the core utility for many users, yes.
So how effective can a yield war really be if the core crypto user just fundamentally distrusts state-backed anything?
Well, that's the high-stakes gamble. Domestically, I think they're targeting the liquidity that's trapped in big tech.
Right, the Alipays and WeChat Pays.
Exactly. It's a calculated move to pull those massive floats out of those closed-loop systems and back into the banking system where they have more visibility.
And internationally.
Internationally, they're betting that a reliable, interest-bearing CBDC is way more attractive for cross-border payments, especially for, say, BRICS nations looking for de-dollarization tools.
Which brings us to what you called the store value paradox. It's a real tightrope walk.
They have to get this yield just right.
Yeah, if the rate is too high, you cannibalize your own traditional bank deposits, you create instability.
And if it's too low, nobody uses it. The whole thing stalls.
So if they nail this calibration, what's the immediate quantifiable risk to, say, regional stablecoin pools outside U.S. oversight?
The risk is a measurable, sustained capital drain. If they succeed, they legitimize the idea of digital sovereign yield on a scale we've never seen. It just creates this powerful new gravitational pull for liquidity.
And that Q1 rate is going to tell us exactly how much liquidity China is willing to try and pull out of the global crypto market.
Okay, shifting focus now to the West and also back to Asia, because this idea of institutional entrenchment is being validated, not by speculation, but by massive surgical capital flows locking down supply and infrastructure.
This is the crypto market well, adulting in real time. And let's start with Ethereum, because we've just seen a historic reversal in the staking queues.
A reversal that signals a supply shock isn't just coming.
It's already brewing.
So tell us about this historic flipping.
For the first time in 6 months, the Ethereum validator entry queue, so that's people waiting to stake new ETH, has surpassed the exit queue.
The line to get in is longer than the line to get out.
Much longer. We have 745,619 ETH, which is roughly, $2.2 billion waiting to get into the staking system.
And that's creating a 13-day wait time.
A 13-day wait. Compare that to only about 360,000 ETH queued to exit.
So a 13-day backlog for staking entry. What does that practically mean for the market?
It means the demand from institutions is just overwhelming the network's capacity to process new validators. I mean, when you see a huge entity like BitMine Immersion Technologies stake over $1 billion, that's 342,560 ETH in just 72 hours.
They're actively tightening the liquid supply on the open market.
They are, and it tells you that institutions are viewing ETH less like a commodity to trade and more like a yield-bearing internet bond. It's a long-term asset to lock away. That's balance sheet planning, which is a totally different kind of decision-making.
And on the Bitcoin side, we're seeing that relentless corporate defense. MicroStrategy was back at it.
Of course. They used this reporting window to grab another 12,229 Bitcoin for about $108.8 million.
At an average price of $88,568.
And this persistent buying is just so critical. It acts as a powerful soft floor for the market. They're just constantly absorbing sell-side pressure around these key psychological levels.
It provides a cushion for the whole ecosystem.
And it's not just about holding assets. It's about capturing the infrastructure. We saw a huge move in South Korea.
Right. Murray Asset Group, a financial titan with over $500 billion under management, is in talks to buy Corbit, the country's fourth largest exchange.
But Corbit has tiny trading volume compared to its peers. So why? What are they willing to pay up to $100 million to get?
They're buying the regulatory moat, the coveted real name account license, and the banking relationship with Shinhan Bank that comes with it.
Exactly. They aren't buying customers. They're buying the legal permission slip to vertically integrate everything: custody, execution, and eventually product issuance.
Like the ETFs everyone expects in 2026.
They're owning the regulated stack.
And you can see this pressure for the ecosystem to adult in the data. The real-world assets sector, RWA, has officially overtaken DEXs to become the fifth largest category in DeFi.
Now at $17 billion in total value locked.
That shift tells you everything about who is driving the capital flows.
It's not speculative retail. This growth is institutional balance sheet demand. They want to access U.S. Treasury yields on-chain through things like BlackRock's BUIDL and Ondo Finance. In this higher-for-longer rate environment, capital is just choosing stability and yield over speculative risk.
Okay, let's shift now to the immediate price action and the structural risks that these institutional allocators have to navigate, starting with Bitcoin's move in the last 24 hours and why it just couldn't hold 90,000.
The price action was really defined by a violent liquidity hunt. We saw Bitcoin punch right through that key psychological level, hit $90,325, and it just triggered a cascade of short liquidations.
Classic shakeout.
Classic. But the immediate rejection just confirms what we've been saying.
That $90,000 is still the primary line in the sand.
It is. The refusal to sustain that level is likely a mix of industrial miners hedging their production cost stacking sell orders there and institutional desks doing some year-end rebalancing.
Using that level to offload some risk.
Right. But immediate support seems locked in at $87,500. The order books show a lot of algo bots actively defending that $86,000 to $87,000 range.
And we also saw funding rates for perpetual futures spike, highest they've been since mid-October. What does that leverage signal tell us?
It definitely indicates a resurgence of risk-on, speculative long positions. People are paying a high premium to hold those leveraged longs. But, and this is important, total open interest is still below the peaks from earlier this year.
So the rally is leverage-driven, but not yet supported by a massive wave of fresh capital.
Exactly.
Speaking of risk, we have to talk about the centralization creep we saw with the Flow blockchain governance crisis.
Yeah, this was a big deal. A $3.9 million exploit happened on the execution layer.
And the initial response was, well, highly controversial.
It introduced existential risk to their whole promise. Validators initially executed a chain rollback. They just reversed history to negate the exploit. And that move...
The idea that we can rewrite the ledger if we need to.
Yes. It completely blindsided ecosystem partners who built on Flow's promise of immutability.
And that raises a fundamental question for any institutional investor. If a high-throughput chain can just unilaterally rewrite history, where is the decentralization premium?
Why invest in that L1 at all if the founders just act like a centralized board in a crisis? It breaks the whole premise.
So what was the final resolution?
Well, the key insight here is that they ultimately abandoned the full rollback. They shifted to an isolated recovery plan, which froze and programmatically burned the illicit tokens instead of reversing everyone's transactions.
The fact that the immutability of connected chains, like Ethereum, acted as a check on them is really the story here.
It is. It highlights the risk allocators have to consider on chains that might favor speed over absolute security.
And that centralized risk is compounded by the threat landscape. We saw this massive breach involving Ubisoft,
linked to a critical vulnerability in MongoDB. And this is not just a gaming problem. This is a silent threat to the whole ecosystem.
So break this down for us. What is MongoBleed?
It's a serious flaw, CVE 2025 1.847, and how MongoDB handles zlib compression. Basically, it allows an unauthenticated attacker to read uninitialized memory.
And in practical terms for a crypto platform, what does that mean?
It means if an exchange is using an unpatched MongoDB server, and there are over 87,000 of them exposed globally, an attacker doesn't even need a username or password to potentially pull out extremely sensitive data.
Like API keys, user PII.
API keys, session tokens, you name it. It's a huge, lingering threat that demands immediate patching.
And let's wrap the risk segment with regulatory friction in Asia. South Korea's FSC expanded the travel rule dramatically.
They removed the 1 million KRW threshold, which is about $680.
A complete game changer. Before, small transactions were exempt.
Now, every single crypto transfer in Korea, regardless of size, has to be accompanied by identity data. The stated goal is to stop smurfing, breaking big illicit transfers into tiny ones.
But the consequence is just massive friction for the average user.
Exactly. It kills the micropayment use case for crypto in Korea and is just another move toward consolidation and regulatory control.
So to synthesize all this, what we're seeing are these simultaneous structural conflicts playing out. On one hand, you have sovereign states trying to accumulate monetary control with yield.
And on the other, you have global corporations accumulating staking yield and building these infrastructure moats.
At the same time, you have this regulatory consolidation in Asia crashing into centralization risk and these critical security flaws in the tech itself.
And while that structural narrative is positive, the traditional investment product flows are, still catching up. CoinShares reported a big outflow, $446 million net for the week.
Primarily driven by that continued regulatory uncertainty in the U.S. after the Clarity Act delay.
But that outflow was very specific, wasn't it?
It was. The U.S. saw the outflows, but a place like Germany saw notable inflows. And, more importantly, you can see institutional positioning shifting. They're trimming a little BTC and ETH, taking profits.
And rotating into high beta alts like Solana and XRP. It's a classic risk rotation. It proves the smart money is positioning now, not waiting for 2026. They're moving into proven utility, yield, and infrastructure.
So we've seen China pivot to state-backed yield and Western institutions pivot to infrastructure yield.
Two competing gravitational forces that are going to define liquidity next year.
Which leaves us with this provocative thought for you to consider. If China's interest-bearing digital yuan successfully legitimizes the concept of state-backed digital currency yield on a massive sovereign scale, will that development ultimately force the U.S. dollar-pegged stablecoin issuers to innovate and finally provide competitive yield solutions to retail holders? Or will the overwhelming gravitational pull of a risk-free state-backed yield simply drain essential liquidity from the global crypto markets?